let's say you buy a property for $100,000. Are you looking to create equity so you can get that equity to work? Or do you have equity and you're looking to invest it to be able to create? Cash flow will get you out of your job. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to video, we're going to be discussing how you can create cash flow in your multifamily deals. In this current market cycle that we're in, it appears as if a lot of your deals are not cash flowing. Remember, there are four parts of a market cycle. There's the recession, there's the recovery, there's the expansion, and there's the hypersupply. We're going from the buyer's market, which is the recession and recovery, all the way to the seller's market, which is expansion and hypersupply. In a seller's market, prices are elevated, cap rates drop. It's a lot harder to create cash flow on the buy. What you're trying to accomplish is cash flow through your pro forma, through increased operations, through adding value to the property. Why else are you going to buy multifamily if you're not going to ultimately cash flow? That's a good question. Maybe you shouldn't be cash flowing in your multifamily. That's heresy. You can't say that, Gino. I've been taught that I need to cash flow in my deals. Yes, ultimately, that's where you want to get to. But let's say you're just starting out and you don't have equity. Because really, ultimately, the name of the game is to create equity. And from that equity, you get cash flow. Now, that doesn't make sense to me if I'm just starting out. Well, if you don't have ownership, and one other point, equity doesn't mean dollars. Equity can mean you're creating equity through seller financing. Someone's holding a note and you have equity in a deal that way. But you need some type of ownership. You need to own a part of this deal. And as you're creating equities in this deal, you're just taking that equity and buying more real estate. If you're starting out, you have zero equity. Let's say you buy a property for $100,000. And a year later, you sell it for $300,000. You've got $200,000 in equity. You're pulling out $200,000 in equity and hopefully putting it down on another property. That $200,000, if you're earning 8% on that, that's your $16,000 a year. 200,000 times 0.08, which is $16,000 a year. That's your equity. Everyone that I speak to, when I ask them what's their financial freedom number in real estate, when they want to get out of their job and what do they need to make per month with cash flow? Typically, it's $10,000 a month. Now it may be up to $15,000 a month. If you need $10,000 a month in cash flow, how much equity do you need to be able to be earning that $10,000 a month? If you have $1 million of equity and you're earning 8%, it's $80,000. If you have $1.5 million at 10%, that's $150,000. So you need around $1.5 million in equity, earning around 8% to be able to be generating $10,000 a month. So for me, the question is, where are you in your journey? Are you looking to create equity so you can get that equity to work? Or do you have equity and you're looking to invest it to be able to create cash flow? That's the delineation. When Jake and I started out, we just needed to buy some properties to start cash flowing. And then from there, refinancing that equity out and putting it into the next deal. It takes a lot longer to do that. Now, we were fortunate that we started out in a buyer's market. We started out in 2011. Deals were, buying at actual 10% cash on cash returns day one. And everyone's like, well, those were the glory days. They weren't the glory days because it was difficult to finance a deal. And guess what? That's happening now. We just signed on a 68 unit deal, almost a $13 million deal. It's $12.5 million. Banking has gotten tight. It's a phenomenal deal. They want more money down. Their debt coverage ratio is higher, means you need to come out of pocket with more money. They're being very difficult with their interest-only terms. The interest rates, it's getting back to where it was in 2011. The deals were there, but it was really hard to finance. So what ended up happening was sellers, if they had to sell, had to drop their prices. So back then, you're buying deals, cash flowing day one. Phenomenal. It's starting to get back to that right now. Everyone's complained over the last couple of years, cash flow is gone, cash flow is gone. It's one of the main reasons, at least in my estimation, is people did not know how to buy right, number one. And number two, they weren't looking at it as a business. What they were looking to do was looking to buy a property for $1 and then 2 years later, sell it for $2 and they make their equity there. They weren't looking to grow and expand the business and to cash flow the business. If you're in a syndication model and you're raising money from other individuals, guess what? Your cash flow comes from acquisition fees day one. If you don't put money into your own deal, then you're not cash flowing because there's a preferred rate of return typically in these syndications. And the first 6, 7, 8%, whatever the pref rate is, goes to the LP investors. Now, hopefully, if you're a GP or general partner in these deals, you're putting money into your own deals. So you'll get cash flow that way. But if you're looking to cash flow in a syndication and you don't have any money, your net cash flow is coming from the AC fee. And on the back end, when you sell, you're crystallizing that equity. Now, I always like to say to people, cash flow will get you out of your job. Equity will keep you out of your job. As you start investing, I want you to think about a couple of things that are going to affect cash flow. The first one, we already mentioned, is the market cycle. Depending on where you're buying. And when things are doom and gloom, things are ugly, everyone's running to the exits, that's when cash flow is more popular. That's when deals will cash flow because cap rates are increasing, prices are dropping. But it's really difficult to buy at that point. Can you imagine buying a property back in 2013 and still holding it today? Well, I can, because we've bought properties in 13 and 14 and 15 and we still own them. At those price points where those rents have escalated, the cost basis is still there. We have refinanced that equity out, but we haven't laden them with debt. They're still around 60, 65% LTV. So, and you're looking at it from that perspective, the first one is the market cycle. Where are you buying these assets? Now, the next factor when you're looking at cash flow is the market itself. If you're buying deals in really low cap rate markets, it's a lot harder to cash flow unless you can get that property repositioned and put a ton of value on it. But you know, when you're buying a property in these low cap markets, if you're a value investor, that's where you want to be because you're adding $1 of value at a 5 cap. You're getting double the bang for your buck as if you're putting $1 value in a 10 cap property. It depends upon your strategy. When you hear somebody say, I'm not buying in California because there's no cash flow, well, they're not looking for cash flow. They're looking for cash flow, They're not looking for equity. There are investors out there that are looking for big chunks of equity. There's no right or wrong. I think when you're looking solely focused on equity, it's a little bit more riskier because you're trying to time the market. You can always buy real estate. You can't always sell real estate. That's the issue. So if you're trying to time the market, you may be able to having to hold your real estate a little bit longer. And guess what? If you're not cash flowing, you're going to have to be able to put money into this deal. So understand that. And the next one, I think it depends upon the investor. Some investors don't want to cash flow. They see the merits in buying deals that have a lot of equity upside, appreciation. You're buying a deal in California for $3 million. 6 years from now, it's worth $5.5 million. If you had cash flowed $20,000 a month, for the next 3 years, you may have made $400,000 or $500,000 on your cash flow, but that investor made $2 million on the equity. There is no right or wrong. It depends upon what you're trying to accomplish. But I will say this, as you get older and as you become more of a mature investor, and as you start retiring, people don't have a net worth problem. They have a cash flow problem. They have all this money saved up, but they're afraid to touch the principal. They don't have any cash flow coming from it. So understand what you're trying to accomplish. For Jake and myself, we want both. We're in an amazing market, Knoxville, Tennessee, the east part of Tennessee, where we're able to buy deals where there is cash flow. Maybe not day one, although this deal we're buying right now, the 68 unit, it is going to be cash flowing day one because we're buying it at a good rate. We're getting great debt on it, and we're putting a little bit more money down. But you're not only looking for that cash flow, but you're also looking for the equity, the appreciation down the road. You're getting both. You're trying to pull both levers. I think the next one, when you're looking at a deal, if it's cash flowing or not, is the asset class itself. Now, the deal we're buying, it is an A property. It's an A. It's built in 2024. It's a brand new property. Those assets are a lot harder to cash flow. Those assets more are for wealth preservation. Those assets down the road, maybe the next 3 or 4 years, as rents are increasing and as your debt is stable, those assets will cash flow. It may take a little bit longer. As you go down the asset class, the Bs will cash flow a little bit more. There's a little bit more risk than the As. The tenant base is a little bit different, but they will cash flow a little bit more than the As. Now the Cs, those are properties that are 25, 30 years and older, a lot more deferred maintenance. Typically, cap rates are higher, although in this previous market cycle, they really compressed. Those assets are going to cash flow even more. And why is that? Because those tend to be riskier. And a riskier asset, especially in a market, has higher cap rates. Because when you're buying a property, you're buying an asset, you're basing it based upon the future value of your income stream. So when you're in a market that's a lot riskier, it's uncertain if you're going into the future, if you're going to collect that income, especially in a market, if you're declining population, if rents are declining, you're obviously going to be paying less for that asset. Hence, the cap rates are higher. And the same thing with properties that are older, 25, 30 years older. There's more risk in those properties. They're older. The plumbing's older. There's more deferred maintenance. More money is going to have to come out of pocket to fix these properties. Therefore, investors in a sane market are going to pay less for those properties. They should. There's more work. There's more risk in those properties. The residents aren't as qualified. It's much more management intensive. And that's where most of us beginning investors started. That's where Jake and I started. And when we do see one of those properties pop up, we will buy those right now at the right price. We're not paying 4 caps and 5 caps in this market cycle for a C property. It's just not happening. Unless, of course, rents are at $500 and we're buying an in-place 4 cap at $500 in rents, and we know rents can go to $1,200, which we've done. And then all of a sudden, the after repair value of that cap rate is a 12 or a 13, and then we can bring this cap rate back down to a 6 or a 7, then we've got a home run. We can do that because we know where rents should be, but it really needs to be a great deal in a great market with maintenance that we can take care of and just executing that business plan. So understanding the asset class is important. If you're starting out, the goal is to create equity, and the goal is to try to build that equity and crystallize it and pull it out and to continue to grow. Now, a lot of investors want to sell. What you can do is when you're fixing these assets, think of refinancing the property. That's crystallizing your equity. You're holding on to the asset. And what really ends up happening is after 3, 4, 5 years of owning this asset, as rents continue to rise, obviously your expenses are rising. Usually, expenses don't rise as high as income does. Unfortunately, over the last couple of years, you've seen what's happened with insurance and with property taxes. It's been brutal. I think this is going to slow down. And I think over the next 4 or 5 years, rents are going to outpace that. So if your rents are outpacing your expenses and your debt's the same, guess what? You're going to start cash flowing even more. I think ultimately what you need to do is when you're looking at a deal, yes, cash flow is still here. Investors in the long run are not going to invest in real estate, at least in my opinion, and at least in the shorter term, for just purely equity appreciation. There are markets that you can do that. And guess what? Most of the rest of the world, that's how real estate works. A lot of these assets in the rest of the world, in multifamily apartments, they don't cash flow. They just put money there. It's really a hedge against inflation. Understanding what your investor you're trying to accomplish. If you've got capital coming from overseas into a market into the United States, they're underwriting the deal differently than if you're looking for cash flow. They're just looking to preserve their wealth. They're looking to keep it as a safe haven. They're looking for a way to grow it, preserve it, and keep it safe. That may not be what you're trying to accomplish. You may be trying to leave your job and you're saying to yourself, there's no cash flow here. Well, guess what? That market may not be providing that. Select a market that works for you. Look for these markets, these secondary markets that are a little bit smaller than these primaries. Let's say Kansas City, for instance. It may not be the primary market. Omaha, Nebraska, Tulsa, Oklahoma. You've got the Knoxville, Tennessees of the world, Greenville, South Carolinas. These really aren't primary markets. They're sort of secondary markets where there's still some cash flow left. Cap rates are a little bit higher than the primaries, but there's still equity appreciation because those markets are still growing. So if you're looking for cash flow, that's what I would do. And we just got fortunate, Jake and myself, from the very beginning when we went down to Knoxville, Tennessee back in 2011. Little did we know that that market really comprised it. Now, if you take a look at Nashville, which is west of Knoxville, 3 hours west of Knoxville, primary market, it's been really driven up. There's been a lot of demand by the institutions, great population growth, great job growth. Cap rates are really compressed. They're around 4 for an average property in Nashville. That market is a lot harder to cash flow. But if you're buying those assets and you're trying to fix them up and increase the value, really what you're doing is you're trying to create an equity play there. So let me wrap this up for you as you're looking and as you're trying to diagnose what you're trying to accomplish in multifamily. If you're newer, the goal is to create equity. And once you create the equity, put it into deals to start creating cash flow. The more deals more equity ownership you own in the deals, the more you're going to cash flow. Learn how to buy right. What is your buy right criteria going into it? Pick a market that has a blend of both. If you're looking in California in certain markets and you're saying, well, I can't cash flow in this market and you want to cash flow, you're going to have to be looking for another market. And then ultimately understand where we are in the market cycle. As we start leaving the seller's market, going into the buyer's market cycle, you will find more deals where you're going to be able to cash flow. And it's ultimately, cash flow is like owning a business. There's a couple of ways to own a business. You can buy a business where it's cash flowing day one and you're continuing to get that dividend, that monthly payment. Is that what you're looking to do in real estate? Ultimately, that's what you want to do. You want to own these assets that make you pay every month. But sometimes you need to buy a business, create value, and sell that business and extract that equity and put it into a deal. It's all about your goals. What are you trying to accomplish in real estate? I want to thank you for spending part of your day with me on this how-to. It's such an important how-to. I hope I've really, taken some of the confusion out of cash flow and what you're trying to accomplish with real estate. Thanks for spending part of your day once again, and I'll see you on next week's how-to. Take care, everyone. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.